Hello everyone, Clifford Bennett, Chief Economist, ACY Securities. We saw some interesting data out in Europe overnight where German inflation hit an incredible 7.9%. We all know the reason why, but that doesn't change the fact that such an extreme number is going to do incredible damage to consumer behaviour and business behaviour as well, which will again slow the European economy. Now, the ECB, there's talk the ECB may hike by as much as 75 points, and that gave support to the euro on the day, and we may have seen some euro stabilisation for the moment. This won't, however, change the long-term outlook that the interest rate differential to the US dollar will remain extremely high and may even widen, that gap may even widen as the ECB raises rates itself aggressively, because it's unlikely to do so at the speed the Federal Reserve has and has indicated it will continue to do. Generally speaking, for Europe, I still see a very high likelihood of a recession there, a dark recession if you like. Energy rationing through winter is very probable. It's not a definite, but it is highly probable. And we know that Germany has already instituted some requirements of businesses about their heating systems and air conditioning systems, etc. So there's already some form of energy rationing creeping into the system as the EU desperately tries to review regulations on energy pricing to add some relief, if you like, to the consumer there. But the consumer may get some relief on that side, but the ECB will be raising interest rates. And if they do 75 points, that will really shock the consumer and further slow consumption generally. Over in the US, we saw a relatively strong, well, a still strong, highly elevated job openings number. Now, a lot of people go, oh, look, that means the economy is strong. To me, it doesn't indicate that. To me, it's an indicator of an economy that is to some degree dysfunctional at the moment. In other words, it's not operating in the normal way that an economy does. And we all know that there are other factors at play here or other indicators that the US economy is somehow not the way it once was, with high inflation, the Fed hiking, high job openings, but companies having trouble filling those vacancies as the economy really is slowing there, with retail sales flat as well. So consumer sentiment, business sentiment in the US at their lowest levels since the 1950s. So again, I see recession risk in the United States as well. In both cases, this isn't going to stop the respective central banks raising interest rates. Over in Europe, it's a very different position to that of the US, of course, because at really zero levels of interest rates and just beginning to hike, the ECB has some room to move to the upside. The Fed has indicated that even though it's come some way, it still has a lot further to go. So the outlook for both economies is a little bit dampened by all these factors, and I would remain very cautious on the equities front. We saw US stocks make yet another new low since that recent high, and it is a trend that's developing and it's turning into, I think, what is the first leg of another major re-establishment of that downtrend of the first half of the year. So look for lower equity prices generally going forward. There may be some respite from time to time, but the outlook remains still somewhat negative. Thank you very much. Clifford Bennett, Chief Economist, ACY Securities.